The headlines are all over the place. The Federal Reserve just cut rates, which should be good news, but the market is still acting jittery. It feels like everyone is holding their breath, waiting for something to break. This is the new playbook. Keep you in a state of constant low grade anxiety. They want you to be confused. They want you to do nothing or worse, sell at the first sign of trouble. Well, in this video, I'm not just going to tell you why I'm not scared. I'm going to show you why this widespread caution is the single best signal you have to start buying. We're in a strange moment of market limbo. It doesn't feel like a crash, but it definitely doesn't feel like a raging bull market either. Every news alert, every analyst, every talking head is sending mixed signals. It's a chorus of uncertainty and it's deafening. But what if that uncertainty isn't a warning, but a smokescreen? What if the very indecision gripping the market is creating one of the best wealth building opportunities of the next few years? Most people will hear this noise and stay on the sidelines. They'll let their cash get eaten away by inflation, too scared to buy the dip and too scared of missing the rally. But a small few, the ones who understand how this game is really played, will do the exact opposite. They will see the hesitation for what it is, a signal, and they will use this moment to methodically build positions in world-class assets at reasonable prices. Today, I'm going to show you how to be one of them. To understand the opportunity, you first have to understand the source of the anxiety. And right now, that anxiety is palpable. It's not just a feeling, it's being actively generated by a series of events that on the surface look confusing. Let's break down what's really happening. The epicenter of all this confusion is, as always, the Federal Reserve, the Fed, has actually been pretty busy. They cut interest rates in both September and October, bringing the benchmark rate down to a 3.75% to 4% range. On top of that, they've officially announced an end to their quantitative tightening QT program, which will stop the drain of money from the financial system starting in December. Now, in plain English, that's the central bank taking its foot off the brake and starting to gently press the accelerator. So why isn't the market roaring? This is where the noise machine kicks in. Despite these positive moves, there's a constant drumbeat of worry. First, inflation is still hovering around 3%, which is higher than the Fed's 2% target. Second, there are signs of a softening labor market. And third, the recent government shutdown created a fog over economic data, leaving everyone guessing. This creates a perfect storm of uncertainty, where good news from the Fed is immediately met with a "but what if" from the media. The result of this narrative squeeze is that investors are cautious, even if they aren't in a full-blown panic. The secured overnight financing rate, or SOFR, a key measure of overnight borrowing costs, is stable around 4.00%, right in line with the Fed's new rate, not spiking like it would in a crisis. The CNN Fear and Greed Index has been hovering in the fear zone, with recent readings around 22 to 34, but not the extreme fear level of a market meltdown. The Volatility Index, or VIX, Wall Street's fear gauge, is around 20. That's elevated, showing uncertainty, but it's a far cry from the 30s or 40s you see in a real crisis. All this data confirms what you're feeling. Investors are hesitant and nervous, and that's a rational response to the conflicting headlines. Fed cuts are good, but persistent inflation is bad. The economy is growing, but the labor market is softening. The average investor sees this and thinks, the experts are divided, I'll just wait and see. And that is a completely understandable reaction, encouraged by every headline that plays up the drama. They are telling you that the smart thing to do is wait, and that is exactly where they are wrong. This is where we need to step back and look beyond the headlines. We need to talk about the psychological engine that drives these market conditions. Because what's happening right now is not just a financial phenomenon. It's a masterclass in human psychology. And if you don't understand the psychological game, you're destined to be a pawn in it. The contrarian investing philosophy is built on a simple, powerful idea. Markets are not rational. They are driven by the swinging pendulum of human emotion, specifically fear and greed. Warren Buffett, the master of this philosophy, said it best: be fearful when others are greedy and greedy when others are fearful. Right now, the world isn't greedy, but it's not in a state of outright terror either. It's fearful in a quiet, cautious way. And the market is designed to exploit that hesitation. Let's call this what it is: the hesitation machine. It's a predictable pattern that plays out not just in crashes, but in these long periods of uncertainty. It has three key components: herd behavior, loss aversion, and a self-fulfilling sideways grind. First, let's talk about herd behavior. Humans are social creatures. We look to the crowd for cues, especially when we're unsure. In the market today, the herd isn't stampeding for the exits. It's frozen in the middle of a field, too scared to move forward and too scared to run back. Everyone is waiting for a clear signal, and because nobody is moving, the signal never comes. This is social proof in its most paralyzing form. The act of waiting by the masses validates the decision to wait for each individual, regardless of the positive underlying signals, like Fed rate cuts. The second, and perhaps most powerful psychological force at play, is loss aversion. Research in behavioral finance shows the pain of losing is roughly twice as powerful as the pleasure of gaining. During a period of choppy sideways markets, this bias runs rampant. As you watch your portfolio go up one day and down the next, your brain isn't celebrating the gains. It's fixating on the drawdowns. The desire to avoid the next drop becomes all-consuming. And what is the easiest way to avoid a loss? Don't invest. By staying in cash, you avoid the emotional pain of volatility, but you also miss out on the opportunity to buy great assets before the next major move up. People are essentially paying a premium in the form of lost potential gains for emotional relief. When you combine widespread herd behavior with intense loss aversion, you get the third component of the hesitation machine, the self-reinforcing sideways grind. It works like this. A piece of good news, like the Fed ending QT, should cause a rally. But it doesn't, because loss-averse investors are waiting for the all clear. Since nobody is buying, the price goes nowhere. This lack of upward momentum then validates the herd's decision to wait because nothing is happening. It's a vicious cycle that feeds on itself, keeping asset prices below where they probably should be, and it's how market bottoms are slowly formed over months. Now, here is the most important part. Who benefits from this machine? The beneficiaries are the ones with the capital and the emotional fortitude to stand apart from the frozen herd. They are the institutional investors and savvy individuals who understand that the hesitation machine's purpose is to shake out the impatient. They know this process allows them to slowly and methodically buy incredible assets at fair prices from people who are acting on emotion rather than on analysis. This is the great transfer of wealth in financial markets, from the impatient to the patient, from the emotional to the disciplined. Their panic isn't a scream, it's a whisper of doubt, and that doubt is your opportunity. Understanding this dynamic changes everything. The market chaos stops being a terrifying storm and starts looking like a predictable, overcast day. You realize that the intense feeling of uncertainty you have is not a unique personal failing, but a manufactured and predictable psychological response. And once you see the machine, you can choose not to be a cog in it. You can hear the chorus of doubt and recognize it for what it is, the overture to a buying opportunity. This is the moment where we pivot from defense to offense. Acknowledging the uncertainty and understanding the psychology behind it is crucial, but it's not enough. Now we translate that understanding into a concrete, actionable strategy. The very elements causing the widespread hesitation are, when viewed through a different lens, the exact reasons why I am getting ready to deploy capital. The fear is not a reason to run. It is the starting pistol for a race to acquire undervalued assets. Let's construct the contrarian thesis. It's built on three core pillars. First, correctly interpreting the Fed's actions as a clear positive signal. Second, recognizing the three golden opportunities that are only created during periods of widespread doubt. And third, having a clear plan for what to target. Part A, believing the Fed. Let's revisit the Federal Reserve's actions, but this time let's look at them from a contrarian perspective. The mainstream narrative is that we can't trust the Fed's dovish moves because of other risks like inflation, but the contrarian view is simpler. Just believe what they are doing. They have cut rates twice and are stopping QT. These are not small things. These are the most powerful tools the Fed has to encourage economic activity and support asset prices. Their goal is to ensure a soft landing and prevent the very recession that everyone fears. By cutting rates and ending QT, they are proactively adding liquidity to the system to keep it stable. This isn't a secret. It's their stated policy. This creates what I call a cushioned environment. The Fed is communicating to the market that while there will be volatility, they are actively working to support the economy. They are putting a floor under the market. This dramatically reduces the tail risk, the risk of a catastrophic wipeout scenario. And when you reduce the worst case scenario, it gives you the confidence to take calculated risks. The caution in the market is about the what ifs. The opportunity is in focusing on what the world's most powerful central bank is actually doing. Part B, the three golden opportunities, forged in doubt. The Fed's actions provide the backdrop, but the real opportunities are created by the market's psychological paralysis Hesitant markets create inefficiencies, and inefficiencies are where smart investors make their money. There are three specific types of opportunities emerging right now. The first golden opportunity is the valuation gap. In a greedy, euphoric market, asset prices often get ahead of their fundamental value. But we are not in a greedy market. We are in a market driven by caution. Good news is shrugged off. Solid earnings reports are met with a sell the news reaction. This creates incredible bargains. High quality, world class companies with strong earnings and dominant market positions are trading at reasonable multiples simply because there isn't enough broad participation to bid their prices up. This is the proverbial baby being left in the bathwater. An investor with cash can step in and buy these fundamentally sound assets at a discount to their future potential. This is the closest you get in public markets to buying a dollar for 75 cents. The caution of others allows you to buy assets based on their long term value, not their short term lack of momentum. The second golden opportunity comes from behavioral hesitation. This is the direct result of the herd mentality and loss aversion we discussed. As uncertainty reigns, investors demand a higher margin of safety before they buy. We can see this in the data. When the fear and greed index stays stuck in fear or neutral for months on end, it's a quantitative signal that logic has been supplanted by emotion. These are not just interesting data points. They are markers of accumulation phases before the next big trend. Buying when sentiment is muted has historically been an incredibly profitable long-term strategy. You are using the market's own emotional state as your entry signal, while everyone else is consumed by the narrative of uncertainty. You are looking at the data, which shows that such extreme levels of caution are almost always a precursor to a powerful rebound. You are buying the doubt itself, knowing that doubt is a finite resource that eventually gives way to confidence. The third golden opportunity is simply recognizing the power of sidelined cash. In a bull market, holding cash feels painful. You suffer from FOMO as you watch every asset go up. But in a market like this, cash is not a liability. It is a superpower. Cash is opportunity. It is the dry powder you need to capitalize on the valuation gaps and behavioral hesitation that others are creating for you. Investors who were fully leveraged at the top are now powerless. But the investor who was patient, the investor who held cash, is now in the ultimate position of power. They can calmly and methodically deploy their capital into the assets that offer the best long-term value. The market's indecision creates the sale, but only those with cash can actually go shopping. If you are holding cash right now, you have not missed out. You have prepared. Your patience is about to be rewarded. Now, this all sounds great in theory, but turning theory into action is what separates successful investors from frustrated spectators. We've talked about the why and the what, but the how is just as important. Knowing which specific sectors to look at, what price levels to target, and how to structure a portfolio. This is what I do every single day for my private community. If you want to see the exact moves I'm making and the stocks I'm buying in real time, then I highly encourage you to sign up for my newsletter. It's where I share my unfiltered portfolio strategy and my deep dive analysis. The link is in the description below. It's the best way to go beyond the concept and see how a real-world contrarian strategy is executed. Now let's get into the specifics of where I'm looking to put my money. Part C, where I'm putting my money, the contrarian shopping list. This is where the rubber meets the road. It's not about trying to time the exact bottom. That's a fool's errand. My strategy is to begin methodically layering into high quality assets at prices that I believe will look like incredible bargains 1, 3, and 5 years from now. I'm building a portfolio for the next bull market, not trading the next headline. My approach is diversified across three main asset classes: stocks, bonds, and a small speculative allocation to crypto. First, let's talk about stocks. In a market driven by caution, the sectors most poised to benefit from lower interest rates and renewed liquidity often get overlooked. These include technology and consumer discretionary. While these aren't at fire sale prices, they are trading at valuations that don't fully reflect a world where the Fed is easing policy. I'm looking for best-in-class companies within these sectors, the ones with strong balance sheets and real earnings, that are not being fully appreciated. The market's fear today is short-term uncertainty, but the value of these companies is based on their long-term innovation and growth. I'm employing a barbell strategy. On one end, I am buying these high-growth technology and consumer names. This is the greedy when others are fearful part of the portfolio. On the other end, I am adding to positions in more stable defensive sectors like healthcare and utilities. These companies provide essential services and their earnings are less tied to the economic cycle. This end of the barbell provides stability and income to the portfolio, acting as a buffer. It's a strategy that combines a search for growth at a reasonable price with a foundation of safety. Next, let's talk about bonds. For the past few years, as interest rates were rising, holding bonds was painful. But the game has changed. The Fed's rate cuts are creating a golden opportunity for bond investors. Yields on US Treasuries and high quality corporate bonds are attractive. This means you can now lock in a much higher interest payment. Furthermore, should the economic situation worsen and the Fed be forced to cut rates more aggressively, the price of these bonds would rally. Buying bonds now offers a dual benefit: a solid income stream today, and the potential for capital appreciation if the economy slows down further. I am focusing on US Treasuries for safety and on investment grade corporate bonds from companies with rock solid finances. Finally, let's address the most volatile and speculative part of the strategy: cryptocurrencies. There is no asset class more sensitive to market sentiment than crypto. While there isn't a full blown liquidity crisis, the general risk off mood has pushed sentiment down. We've seen this with the Bitcoin Fear and Greed Index recently hitting a low of 10, a signal of extreme fear. For a risk averse investor, this is a reason to stay away. For a calculated long term contrarian, this is the signal to pay very close attention. The argument here is that these sentiment driven dips are what create generational buying opportunities. I am not betting the farm on crypto. This is a small speculative slice of my portfolio, but I am using this period of extreme fear to dollar cost average into the major players like Bitcoin and Ethereum. If you believe in the long term potential of this technology, then buying when there is blood in the streets and sentiment is at rock bottom is the most logical, albeit emotionally difficult time to build a position. Across all three asset classes, the strategy is the same: use the hesitation of the many to build a diversified, long term portfolio at reasonable prices. So let's bring this all together. The market is a sea of confusing signals. The headlines are designed to keep you on edge. The Federal Reserve is cutting rates, but the market is still stuck in neutral. The herd is frozen, and every instinct is probably telling you to wait with them. But now you see the full picture. You see the Fed's actions are a clear positive signal for the future. You see that the market's paralysis is being driven by predictable psychological biases, herd mentality, and loss aversion that create valuation gaps. You see that this environment of doubt is forging golden opportunities for those willing to act. This is the central lesson of contrarian investing. The moment of maximum uncertainty is the point of maximum opportunity. The deafening silence of the hesitant crowd is not a warning to stay put. It is the ringing of a dinner bell for the patient investor. It's a signal that quality assets are available at fair prices, courtesy of those who are trading on anxiety instead of analysis. The choice you face now is a simple one. You can listen to the noise, join the frozen herd, and let hesitation dictate your financial future. Or you can take a deep breath, trust the analysis, and recognize this moment for what it is: a rare window to build wealth for the long term. Don't let them make you panic. Let their caution be your guide. Let their fear be your signal. This is why they want you to sell or do nothing, and this is why I'm buying. This is my strategy, but now I want to hear from you. What are you seeing out there in the markets? Are you buying, are you selling, or are you holding tight? Share your thoughts and your strategy in the comments below. I read every single one, and the best insights often come from this community. And finally, if you got any value out of this video, do me a huge favor and hit that like button and subscribe to the channel for more content like this. It helps the channel immensely and ensures you won't miss the next update. Thank you for watching, and I'll see you in the next video.